So guys, investing doesn't have to be that complicated, even though that is often how it's made out to be. Reaching financial freedom as a long-term investor is not about making frequent trades in and out of stocks and trying to perfectly time what the market's gonna do. In fact, trying to do all that tends to lead to poor results, not to mention more stress. And as Charlie Munger said, the big money in investing is not in the buying and selling, but in the waiting. Which is why in today's video, we'll be talking about 5 dividend stocks that you can feel good about holding for a long period of time without having to worry about buying and selling out of them. I think these are all great companies that you can just hold on to forever, and they all actually have a history of outperforming the market, which is a very nice cherry on top. Now guys, the important thing to keep in mind as we're going through these companies is that we're investing today for 10, 20, 30 years down the road, and the whole point of owning these companies is to someday live off the dividend income they provide. These are all going to be relatively mature, stable businesses that I think have the staying power to be around for a long period of time and continue growing and paying consistent dividends. And in my opinion, they're all going to be resilient to drastic change and disruption well into the future, which is what makes them great long-term investments, with one of the best examples of that being this first company here. All right, now kicking things off with the first stock on our list, Republic Services is one of the largest waste management companies in the country. They collect, recycle, and dispose of trash and garbage, and do so with tremendous scale. I mean, their vertically integrated operations serve more than 13 million customers across the country, including here in Las Vegas. And I'll just say, I'm one of those customers. And for what it's worth, which is probably nothing, I've been pretty happy with the service so far. Now, I think Republic is a textbook example of a business that's resilient to change. It's not a flashy industry by any means, but that's kind of the beauty of it. If you think about it, trash is a constant. People and businesses generate more garbage every single day, and someone has to handle all of that. No matter the state of the economy or what's going on in the world, our garbage still needs to be collected, hauled away, and disposed of. It's just one of those services that never stops being necessary. And because of that, Republic has built an incredibly predictable business. One of the things that I like most about this company is that the great majority of their revenue is subscription-based. And actually about 80% of Republic's revenue has this annuity-like profile, which is a huge advantage. And as we can see, that kind of consistency shows up in their financials too. They've grown their sales, earnings, and free cash flow very steadily over time, which, as I'm sure you can imagine, has trickled down into the dividend, which, as we can see, is very consistent and also growing quite aggressively. And I know it shows a dip there in 2024, but I think it's missing one of the payments that they paid out for the year. And in reality, Republic has actually grown their dividend for over 20 years, so they're almost a dividend aristocrat. And obviously, more important than just the dividend alone, Republic has delivered market-beating returns for shareholders across pretty much every time period. Looking at Republic's total returns against the S&P 500, we can see it has absolutely crushed VOO over the last year. It's seen a gain of about 36% compared to the S&P's about 10.6%. So that's pretty substantial outperformance. Zooming out across a longer period of time over the last 5 years, we can see this spread has even widened. Republic has seen returns of almost 250% compared to the S&P 500's 112%. So it's more than doubled the returns of the S&P in this time period. And then zooming out once more over the last decade, which is a very long period of time, Republic has basically tripled the returns of the S&P 500, which is just incredible. So while this type of business may not seem like the most exciting place to park your money, it is definitely one of the most reliable, and Republic is one of the leaders in this space. I actually really like this company, and it's one that I have on my watch list and would love to add to the portfolio at some point. Now guys, next up is Agree Realty, ticker symbol ADC, which I know a lot of you out there are familiar with, and probably many of you have some shares of this company in your portfolio. This is one of the more popular real estate investment trusts, and they own and lease out retail properties around the United States. But not just any retail, guys. Agree focuses almost entirely on essential recession-resistant businesses. Think grocery stores, pharmacies, home improvement chains, dollar stores, stuff like that. And we can get a sense for who their tenants are from just looking at this slide here. These are the type of places people still go to even when times are tough. Now, what I think really makes Agree Realty stand out is the quality of their portfolio. As we can see, around 70% of their tenants are investment grade related, which means they're financially stronger and are less likely to default. Plus, I think 100% of their leases are are triple net, which is another huge advantage for them. And that means that the tenant, not the landlord, is responsible for paying things like property taxes, insurance, and maintenance on the building, so Agree doesn't have to worry about any of those expenses. Now, on the dividend side of things, with Agree Realty, you're getting a monthly dividend starting at around 4%, which is not too shabby, and that dividend has grown on average by about 6% every year over the last decade, which I think are Goldilocks dividend stats. The combination of that higher starting yield with that, mid to high single-digit growth rate really gives you the best of both worlds, and I think that makes Agree Realty double trouble in the dividend department. But anyway, guys, taking a look at Agree's returns over a few different time periods in the last year, kind of like what we saw with Republic, it is absolutely crushing the S&P. Agree is up about 36%, including dividends, compared to the S&P's 10.6%. Moving on to the 5-year period, we actually see a bit of a flip-flop here. The S&P 500 has actually more than doubled the returns of Agree Realty in this time period. Still, when we zoom out once more across the last 10 years, ADC takes the lead and is up about 276% compared to the S&P's 217%. So we do overall see outperformance across the longest period of time. Now guys, stock number 3 is a company that needs no introduction. I'm sure all of you have heard of Visa. I would be very, very surprised if you've never heard of this company, but interestingly enough, a lot of people, despite how recognizable it is, don't actually know what this business does. In a nutshell, Visa operates as a global payments network, and when a customer buys something from a business, Visa basically checks with the customer's bank to make sure they have enough money to make that purchase. If it all checks out and the customer has enough money, then Visa helps transfer the money from the customer's bank to the business's bank while collecting a fee in the process. So in essence, Visa pretty much operates like a toll booth business, and I absolutely love this company. I've said it before, but I think this is like the gold standard of stocks. I can't think of a company with more perfect financials than Visa. As we can see, everything is just straight up and to the right and growing very aggressively at double-digit percentages. Not to mention the company's debt profile looks very solid, and with a net debt to free cash flow of about 0.5, Visa is bringing in about twice as much free cash flow every year as they have net debt on their balance sheet, which is incredible to see. Having said that, on the dividend side of things, the starting yield is undeniably uninteresting. Coming in at less than 1%, this probably wouldn't be the most suitable dividend payer if you were someone close to retirement, I'll admit. But with that said, if you do have a long time horizon and can afford to let dividend growth and the snowball effect do its thing, then I absolutely think Visa is worth considering, since their dividend growth rate is incredibly high at around 15% on average over the last 5 years. I think that more than makes up for the lower starting yield. Now, like I said, I absolutely love this company, so much so that it's actually the largest individual stock position I have, making up about 9% of my total portfolio. And I've only had this position for maybe a year and some change, and in that time, Visa has delivered a market-beating performance. We can see it's up about 28% compared to the S&P's 10.6. Moving on, just like with Agree Realty, believe it or not, Visa is underperforming the S&P over the last 5 years. Not by much, only by, looks like about 10-11% here, so that's not too bad. But across the longest period of time here, over the last decade, Visa takes the cake and is seeing pretty much exactly twice the returns of the S&P 500. I don't think you can make a video talking about resilient and predictable businesses without mentioning Rollins, which, as many of you guys know, I have been dying to own this company for so long now. In case this is your first time hearing about it, Rollins is one of the world's largest pest control companies. It's a bit under the radar, so I wouldn't be surprised if you're not familiar with it, but I think it's one of those hidden gems. And much like Republic Services, the need for pest control is constant. It doesn't matter what's going on in the economy. Bugs and critters don't care. They don't take a break. And depending on where you live, pests are just a part of life. Whether it's ants, spiders, roaches, termites, you name it. And the thing about pests is that it's really hard to permanently get rid of them. It's almost impossible, which is good for Rollins because it gives the company a reliable recurring demand for its services and helps make it more resilient to economic downturns. Having said that, over 75% of this company's revenue is recurring, and historically they've absolutely crushed it during turbulent times. As we can see during the great financial crisis, they still managed to grow revenue by mid-single digits. And more recently, in the middle of the pandemic, they grew revenue by a whopping 12%. 12%. That's just incredible. And that level of consistency shows up in their fundamentals too. I mean, to me, these financials actually remind me a lot of what we saw with Visa, steady, predictable growth. And overall, this is just a really well-run business. I think what they're doing over there is pure class. It's a real work of art. Now, when it comes to the dividend, it's not gonna blow you away in terms of yield, we'll just say that. It currently sits just over 1%, so it definitely is on the lower end, but what makes up for that, in my opinion, is the dividend growth, which has been coming in at over 17%, and that's also very incredible. All in all, needless to say, I am a huge fan of this company. My only problem with Rollins is that it never seems to go down in share price. This thing just keeps going up and up and up. And as we can see over the last year, it has basically doubled the returns of the S&P with a gain of about 21.7% here. And over the 5-year period, it has just barely edged out the S&P with a gain of 118.3% compared to the S&P's 112, so it beat it by about 6 percentage points. But then over the last decade here, Rollins has more than doubled the returns of the S&P 500, up almost 500% in this time period, including dividends, compared to the S&P's 217%. So guys, this fifth and final stock is one that's very near and dear to my heart. This is Vici Properties, which is actually a decent sized position of mine, and I would love to add more to this company. Now, I know a lot of you guys out there already know this company because, like Agree Realty, this is one of the more popular REITs in the stock market. But still, for many of you, this will probably be your first time learning about Vici Properties, and this is one of the world's largest experiential real estate investment trusts. They own a portfolio of iconic properties in top gaming, hospitality, entertainment, and leisure destinations, most notably in Las Vegas. In fact, their portfolio of properties here is kind of like the greatest hits of the Las Vegas Strip. They own properties like Caesar's Palace, the Venetian, the Mirage, which is in the process of becoming the Hard Rock. They own MGM Grand, Park MGM, Mandalay Bay, New York, Excalibur, and Luxor, all of which are one-of-a-kind properties in a city that I think is unlike any other on earth. Las Vegas is also a one-of-a-kind place. Now, at first glance, you might not think of the casino business as being recession resistant, but Vici Properties has proven time and time again just how durable and dependable this company is. Vici's average lease term is extremely long at 40 years, and 100% of these are triple net, which is the same thing we were talking about earlier with Agree Realty. And overall, they've just got a landlord's dream set up. Plus, during the pandemic, when the world basically shut down, they still collected 100% of rent from their tenants and maintained a 100% occupancy rate. That's a perfect score, and that's nearly unheard of in the REIT space. And I think it says a lot about the strength of their contracts and the quality of their tenants. Now, getting into the dividend stats, overall, I think these are the best looking figures we've seen all day. Right now, you can lock in a yield greater than 5% with Vici, and with that comes a near 8% average dividend growth rate. So when combined, I think it's safe to say that Vici is also double trouble in the dividend department. Now, looking at the returns, in the last year, Vici definitely has an advantage over the S&P with a 16% gain. So they're beating the S&P by about 5.5%, it looks like. And looking at the 5-year period, they are really crushing the S&P with a gain of 157.5% compared to the S&P's 112. So what is that, a 45% outperformance? And then going all the way back to Vici's first day on the stock market, which would have been February 1st, 2018. From then until now, Vici has just slightly outperformed the S&P with a gain of almost 128% compared to the S&P's 122.3% in this time period. So Vici's just barely outperformed the market since its inception. And with that said, I think this one and all of the stocks that we talked about today are great ones to just buy and hold on to forever. And with that said, in this next video right over here, I'm telling you about 3 more stocks that are the exact opposite. Many investors like to buy these stocks, but truth be told, they're terrible investments and you should avoid them at all costs. So click right over here to learn about those, and I'll see you in the next one.